Good afternoon, everyone. Welcome to our quarterly webinar. We'll just wait another minute or so for additional folks to dial in and participate. So give us about 1 minute and then we will get underway. Okay, so it's 1:30 Eastern time now. We're past our, so hopefully folks will continue to dial in. As they do, they can pick it up from there. Welcome to our quarterly webinar here at Burns & Wilcox. Hopefully the attendees today will get some insights from it, as we've certainly heard that you have in the past. So at this point, I'd like to just go over some kind of quick housekeeping items here. Of course, if you have any questions, you can ask those questions utilizing the dialog box that's should be on the right-hand side of your screen. We will do our best to get through those questions in the webinar today. If for some reason we cannot get through the questions, or perhaps we don't have an answer, which is unlikely, we will get back to you via email, someone on the panel today, or someone on the team that's more appropriate. So without further ado, I would like to introduce our panelists for today's discussion. First, we have Anela Neuenhuis. Anela is our regional personal lines practice leader down in the, I'll call it the Mid-Atlantic states. She's based in our South Carolina office. So Anela, welcome to today's webinar, and we look forward to your words and insights and comments. Second, we have Peter Kestenbaum. Peter is our managing director in the Burns & Wilcox Boston office. He looks after not only Boston, but of course all of New England there. We welcome Peter. Peter's a fairly new associate to the organization, as is the Boston operation of Burns & Wilcox. So Peter, thank you for your time today, and we look forward to your insights and conversation as well. Peter's going to address commercial insurance within the contract bind space, within what we'll call, a brokerage business that's just above contract bind, et cetera. Third, and last but not least, is Dennis Brady. Dennis is the president of Burns & Wilcox Brokerage, which is our dedicated brokerage group that handles large, layered, shared property casualty professional type placements. Dennis is based in San Francisco. Dennis, we look forward to thoughts and comments today as well. So thanks, everyone. Looking forward to our discussion. My name is Paul Smith. I'm a senior vice president with the H.W. Kaufman Group. I am based in New York. I'm not in New York today, as you can see. We're kind of in the height of the vacation season here, so there's a few of us that have taken some time out to make this webinar happen. Having said that, we typically do these webinars on the first Thursday of each quarter. The first Thursday of this quarter, of course, was the Independence Day holiday, so we've postponed it 1 week. So here we are. So without further ado, I look forward to our discussion today. And again, if you folks have questions, please post those in the chat, in the question box, and we will get to those time permitting, and if not, follow up. So I'd like to start with Peter, if I may. Peter, let's kind of talk a little bit about the balance of 2024. We're at the turning point of the year. We're halfway through. We have numerous binding contracts within the commercial space within Burns & Wilcox. Tell us about some of the exciting things that are going on there, and what you have for our audience today in that commercial binding area within Burns & Wilcox.
Yeah, I tell you what, and thanks, Paul, and thanks for the invitation to talk here. I think everybody gets a lot of information out of these, and it's a pleasure just to share it. I'll start by saying the second half of 2024 will be very telling on how the industry moves forward for the next few years. Our commercial binding contracts, they continue to strengthen, but that's really a direct correlation to the front end underwriting that we have been performing on our end. Just trying to get creative in this environment with our partners to write business. when looking at renewals for the remainder of the year, okay, we'll continue to see increases on the property side. Okay. However, I do suspect that some of those increases will decelerate a little bit to the single digits, but a far cry from the double digits that we've been used to. Okay. On the casualty side, I don't expect to see too much change. However, there's a lot of rumblings about rate on the casualty side. Listen, I think there's been a lot of focus on property in the past, and now that's going to shift a little bit over to the casualty side. So I don't want to get too far ahead of you, though.
Yeah, hey, I couldn't agree more. I think the first 6 months of this year, we've been talking a lot about that perhaps there'd be some stabilization in the property, and the liability or longer tail business would have some catching up to do. And I think that's what we've seen pretty much thus far. Thank you for your comments and insights there, Peter. Anela, from a personal lines perspective, kind of the same question for you. What are you seeing for the outlook for the balance of 2024 within the personal lines sector?
Thanks, Paul. And again, happy to be here. Thanks for the introduction. I think for the remainder of 2024 within the personal lines space, we're going to see, where a lot of our markets across the board have finally reached that point of rate adequacy. So we'll probably see some normal rate increases, that 5-10% on renewals. And then new business kind of in that same range. Obviously, there are going to be some parts of the country that are going to be higher than that, kind of hot spots, maybe Florida, California, all the areas that you would expect to see maybe some larger increases. And then there are going to be some parts of the country that may even just be flat across the board, because for so long we have seen those rates just increase, and now we're starting to see it level out a little bit. I don't really foresee many decreases, though. If there are, they will be very few and far between. So not sure we've quite reached that point of equilibrium, but we're definitely getting there. So overall, not too many large changes. I think we'll just be kind of riding the course for the rest of the year.
Yeah, well, it's been an interesting few years leading up to this, right? You have the compounding effect of rate on top of rate on top of rate. So maybe some of that, I wrote down rate adequacy, the term that you use. I think that makes sense. If I may expand a little bit with you, Anela, can you just give us a little peek maybe into maybe the personal auto space, the personal umbrella space? What do you think it might be the outlook there?
So I think in the auto space, it's continued to be difficult for carriers to make money. And you've seen a lot of those auto carriers kind of pull back or increase rates, increase their guidelines specifically. We personally here at Burns Wilcox don't write a ton of auto business, so we don't see the impact as much. However, we do see it on the personal umbrella side, which definitely plays directly into what's going on the auto market. So on the liability side, umbrella carriers are still, struggling just because of large lawsuits in the past. It's just been very difficult for anyone to make money across the board in that particular sector. However, we are seeing some carriers come back. We actually just heard from one earlier this week that is going to start offering higher limits on the non-admitted side, because that's where they can really get the rate. But we're starting to see some change unfold.
Understood. Yeah, and I think the personal umbrella space is almost primarily impacted by the underlying auto that it sits on top of. So makes perfect sense. So thank you. Appreciate your comments and insights, Anela. Dennis, switching over to you. From a large account brokerage perspective, property casualty, professional lines, what do you think the balance of 2024 might look like? I can't hear Dennis. I don't know if anyone else can.
Can you hear me now?
Yes, we can.
You go. All right. If I had to sum it up in a few words, I would say more of the same from the last time we talked. On the property side, to Peter's point, I've had a couple of brokers describe it as a mellowing of the property market. No longer the double-digit increases, but more the single and some more capacity coming into play. We'll see what the hurricane has to do with the future there. On the professional side, there's a little softening going on, but anything healthcare, medical related, still very tough, and there's some other specific classes. Transportation, still a really tough market, especially excess. I was talking with one of our brokers the other day who's been doing excess transportation for almost 40 years, and he said this is the toughest market he's seen. You've got carriers exiting and a lot of carriers just cutting back on the limits they want to put up. He talked about an account he just wrote recently, run-of-the-mill excess placement, $5 million umbrella. It took him 4 carriers to put it together. So that market remains really tough. A lot of that due to the large nuclear verdicts and what's going on out in the loss arena. Casualty, underwriters are trying to get rate where they can get it. I'm seeing some of that. And there again, that market too on the excess side is pretty difficult. Carriers have cut back on the limits they want to put up. A lot of carriers are looking to move up on their towers and not play a lead position. So it's every placement is a challenge.
Yeah, for sure. Well, you know, that comment you just made about, I think you said 4 carriers to place a $5 million hexa primary on a transportation deal. I think that's very telling in and of itself, right? With, you know, carriers certainly putting up shorter limits. Now there's some short limits for you.
Right.
That's demonstrates that. Again,
and it's the same thing on the casualty side where companies were putting up 25 million at a pop a few years back. They're down to 5 or 10. So on a larger placement where you could wrap it up with 3 or 4 markets, you might need 10, 15.
Yeah, well, and you know, I have a question for you later on. I want to talk to you about the importance and the art, I'll call it, of putting together an excess placement, whether it be excess auto or excess casualty in general. So I'll circle back to you. Thank you for those comments, Dennis. Much appreciated. Peter, I'm going to swing back to you at this point. I believe Dennis and you both referenced, as well as Anela, we're in the beginning of storm season here. We're a little over a month in. We've had 2 named storms to my knowledge. Beryl, of course, had a fairly significant impact and continues to have an impact on eastern Texas. Do you think that some of the first that broke, right? It was, I believe it was the second named storm that early in the season, and it was the first Cat 5 storm, et cetera. So there were some firsts with Beryl. Do you think any of those firsts are going to have kind of an immediate impact on coastal commercial property renewals?
Yeah, well, I mean, that's a good question. That's the one that everybody's asking right now. And I tell you what, it's on everybody's mind because we are in the beginning of the hurricane season, and this is going to be a very, I think, telling hurricane season and how it impacts property markets going forward over the next few years. Beryl's just another example of where I think time and time again, people are underestimating the severity of these storms, okay? It's looking like Beryl's going to far surpass Ike in 2008, probably close to, I think the last time I heard, $3 billion for the carriers. And the hurricane season kicking off with such severity, it's going to cause, I think, the carriers and reinsurance to throw some caution to the wind. The immediate impact will be, you know, minimal as policies are already in place, but you know, I think when we were talking earlier about the comfort level of reinsurers and carriers on their rate adequacy, I think starting off, it's very difficult to ignore how strong this hurricane season has started off and the predictions for the rest of the season. So.
Yeah, for sure. So Anela, back to you, you know, kind of same question, right? A bit of an aggressive start to the hurricane season. Do you think, you know, despite the June 1 and July 1 treaty renewals for many of our carrier partners, do you think that this aggressive start to the storm season is going to have an immediate impact on the personal line space?
Yeah, I think it will, echoing a lot of what Peter just said. I think carriers will continue to be conservative with it being a really wild card of wind season. As experts are predicting, it could be the worst season that we've seen yet. I think we'll see moratoriums come earlier and possibly stay later, just to kind of see how everything pans out as these storms continue to hit. You know, Beryl dumped a ton of rain into Texas, into the middle of the country, up through the Northeast, saw a lot of wind. I think I saw a report of tornadoes in Kentucky as a spinoff of part of that storm. So I do believe that, you know, carriers have capacity out there, but they're waiting to see how this wind season plays out before they start allocating more of it out. And just like I mentioned earlier, just being conservative in what they're doing based on the report so far. It looks, when I checked NOAA this morning, it looks quiet at the moment, but we'll knock on wood, because I mean, we all know that could change really, really quickly.
Yeah, for sure. No question about it. Still too early to tell. So I guess what I'm taking from this conversation thus far, at least on the property side, whether it be commercial or personal, is cautious optimism, and Mother Nature will decide how the market reacts, if you will, over the coming months. So it's still too early to tell. Jury's out, but you know, at this point, an aggressive start, and as you just pointed out, Anela, nothing on the horizon yet. I'm sure other things will happen though as we progress and before we have our next quarterly webinar. Thank you for those insights, Anela and Peter. Changing direction a little bit on the conversation here, Dennis, I'm going to go back to you. And you know, something near and dear to my heart, looking after claims here within the organization, or having that responsibility, I should say, is policy terms and conditions, right? Policy terms and conditions is really what it's all about. We often talk about rate. We often talk about how, you know, rate is you know, going up, down. It's flat. It's whatever the case might be. We've spoken recent quarters about insurance to value and so forth, but I don't think that we've spoken an awful lot about policy terms and conditions and the importance of that, because that's what makes claims covered or not covered. So talk a little bit about what you're seeing in that brokerage space and how, you know, perhaps, you know, a renewal may not look the same as expiring, even if it's the incumbent carrier, and a little bit about, you know, how carrier A may look completely different than carrier B.
You're always going to have that small percentage of insureds out there that are just shopping price. And we have a couple of carriers out there that put out low premiums with not very good terms and conditions, right? But
Sure.
Today, more and more, the terms and conditions really mean a lot and can be the differentiator. I mean, we do form comparisons and terms and condition carrier comparisons on all of our accounts. So we can demonstrate to our agent and our insured the difference between the two policies. And in some cases, we can sell a higher premium because the terms and conditions are better. So it's terms and carriers are starting to tighten up on their terms and conditions and looking at ways of improving their experience as well too. And that goes to your second point there about renewals. You can't, as an agent, as a wholesaler, as an insurer, just assume that the terms you received last year are going to be the same terms that you're going to receive on renewal. And it's incumbent on us and the retail and the insurer to make sure that they're aware of any differences. And I can tell you that in just about every case, there is some tightening of terms and conditions. So really important and a good point. Thanks for asking the question.
Yeah, sure. So, you know, a lot of what we're talking about here really comes down to a whole lot of additional work, right? You have to have more carriers to make a placement. You have to be out in the marketplace and understanding what carriers' appetites are. You have to really closely review policy terms and conditions. There's a lot of work to be done here to ultimately achieve the goal that we have set out here. So really important, the terms and conditions, because that's the difference between claims being covered and not being covered under a policy. So thanks for that, Dennis. Appreciate that. And what I found also interesting in your comment there was that maybe I'm reading between the lines too much, but incumbent carrier could have different terms and conditions upon renewal than they had upon expiration, correct?
Yep, most definitely.
All right, cool. Thank you. Appreciate that. So we talked a little bit about this in our earlier questions, but I want to maybe do a little bit of a deeper dive. Of course, we just had some, kind of significant reinsurance renewals, June 1 and, April 1, June 1, and July 1, of course. So from that standpoint, we talked about property equilibrium, rate adequacy was the term Anela used there. But what I'm hearing in the circles that I run in is a deepening concern regarding liability. So, Peter, can you talk a little bit about, some of those concerns regarding liability and, frequency and severity and, all of that good stuff on the rise?
Yeah, absolutely. And I would agree with what you just said. We've consistently seen a rise in claim frequency, and have only seen, and it's a little bit indicative of a hardening market. However, we've only seen mid to single digit rate increases. Okay, but there's a deep need for additional rate, in some cases more restrictive policy language on the casualty side, excuse me. I think that some of the previous focus that reinsurance had on property will be redirected towards casualty. And let me tell you, just when we thought legal costs and nuclear verdicts couldn't get any higher, we've seen an increase in third-party litigation funding, where the third party is now financing the lawsuit. So no longer are plaintiffs discouraged from filing a suit due to litigation costs. It's enabling them to really take that case further, seek larger settlements, and this is going to continue to have a large impact going forward. And I think, the reinsurers and carriers are really watching it closely.
Yeah, for sure. I had the opportunity to speak on a panel last month in New York, hosted by one of the industry publications. And we talked exactly about that. We talked about nuclear verdicts, litigation funding, and I think the term that we used was false positive with respect to what years look like in 2020, 21, and 22 because of the pandemic, right? So from an actuarial standpoint, of course, you get that false positive because it looked like a decent year, when in reality, all things being equal, absent COVID, it was not a good year. And then I'll call it a decade of soft pricing, very liberal terms and conditions. It's catching up to many carriers right now because you continue to read about reserve strengthening and so forth. So I think it's going to continue, and our industry, not us, not a particular carrier, but our industry needs to really get its arms around what it's going to do with this trend that's moving forward on third-party litigation funding, sympathetic juries, all of those things. So, Dennis, did I leave anything out? Anything you want to add?
No, you guys summed it up pretty good.
Cool. Thanks. Hey, Dennis, I'm going to stick with you for a moment. Boy, again, another topic that we have not talked about, I can tell you that, and something that, you and I shared in a personal conversation that I think is really worth mentioning to our audience today, because it is becoming increasingly important that there's full knowledge of this and that there is an awareness and an understanding of it. And that is the term layer trapping as it relates to excess liability. Can you explain to the audience what layer trapping is and why it's so important to be mindful of it?
For those of you that aren't familiar with the term, for every excess or umbrella placement, there's a price per million. And when you're building towers, whether they're 10 million, 50 million, or 100 million, each particular layer has a price. And in a typical scenario, the layers closest to the primary with the greatest exposure, their price per million is higher than the layers up top. It makes sense, right? Well, as I mentioned earlier, when you could build a 100 million tower with 4 carriers because everybody was throwing up 25 million, it wasn't that big a deal. But these days, it could take 10 carriers. And if you're not working with a broker that knows the marketplace, knows each carrier's minimum premium, has a plan and a strategy in place going into it, you could end up with carriers in upper layers that are potentially quoting or getting more premium than the carriers down below them, layer trapping. And I can tell you that underwriters are not very fond of that. It's not good form, and it can create issues. So anyone out there that's building towers needs to be sensitive to all of the things I just mentioned and make sure that everything's stacked the way it's supposed to be stacked. And Paul, you and I have talked, you've had some of this experience. Did I miss anything, or is that about sum it up?
No, I think I used the term, it's a, it always comes out, right?
Yeah.
When you have a claim, everyone's going to want everyone else's policy, right? They're going to want to see the underlying policies. It's a small marketplace after all. Everyone pretty much knows each other. And I think that the insureds also have an obligation here as well, right? If I'm the purchaser of an excess tower, irrespective of the limits, I want my placement or my deal to be appropriate in the marketplace, because I need to do a renewal next year and the year after and the year after. So really important to ensure that you don't have that layer trapping.
And it's not just when a claim comes up. I mean, it's not unusual today to actually have underwriters ask, what are the layers below me, above me getting? And they talk to one another. So
absolutely, they sure do, for sure. I can't imagine, going back to your earlier reference of the 5x of primary on that auto deal took 4 carriers. Boy, that had to take a lot of work to get that.
And there's another interesting twist on that one too, because as it turned out, the carrier doing the first $1 million was less than the next 3 carriers. And we had to go back, or the broker that was involved with it had to go back and get that carrier to actually increase their premium to have it all fall in line, because no one else wanted to do that lead. So,
well, if the client has a need for X limit and that's the only way to get to that X limit, it's unfortunate and regrettable, but it's necessary, I think, based on what we just said. If anyone has any questions or wants to talk about that, Dennis has a terrific team that around the country and all over in Dallas and Atlanta and San Francisco and Chicago that can speak about that in fine detail. So thanks for that, Dennis. Really important. And we'll certainly address any questions that may come in on that. Changing gears yet again, Anela, back to you. We've talked a little bit about this in the past, and I think perhaps more important now than ever, and that is what I'm going to just refer to as the relevance that the surplus lines or the not admitted marketplace adds to the overall sector. So what does that give us in order to meet the goals and objectives of our clients?
Sure. So, over the past 2 to 3 years, we've seen huge, even, record growth within the surplus line sector of personal insurance. And, because of that growth and because of the freedom of rate and form, a lot of insureds who may not have been able to get insurance in the past are now able to get insurance. We've seen a lot of admitted carriers continue to pull back or become more conservative. And we've seen a lot of surplus lines carriers really push forward and be very creative and robust in their new offerings. We're seeing a huge increase of HO5 policies or full replacement cost coverage where you weren't seeing that in the past. So a lot of those admitted type coverages are now being seen more within our space. That being said, there will probably be a point in time where some of this business starts to trickle back to the admitted market, but that's just the overall cycle. That's how the market stays healthy. It ebbs and flows. We're currently still in a hard market, even though it's starting to mellow out slightly, I think, as Peter had said earlier. But I think overall, this particular sector of the personal insurance market will continue to stay larger than it was previous to the last soft market.
Yeah, so again, importance of the freedom of rate and form and the ability to have that latitude within the E&S or not admitted space. I think the other thing too, and I'd love to get Dennis and Peter to chime in on this from a commercial standpoint. Maybe I'll tee it up with the fact that in addition to the freedom of rate and form, it's also the speed, right? In all due respect, I think that admitted placements when you're working with various regulators and things along those lines there, can take an awful long time to get the change that you need today or yesterday in some instances. So Peter or Dennis, do you guys want to maybe talk a little bit more about, from a commercial standpoint, the growth of the E&S marketplace, non-admitted marketplace?
Peter, would you like to go first?
Sure, sure. Well, I tell you what, red tape is very real on the admitted side, and with the way that insurance has really evolving over the years, you've not been able to pivot quickly enough on the admitted side to obtain rate and to maintain a profit, maintain those the support behind you. What's incredible about the E&S space is we're starting to meld into a period where policies and forms are very robust, very broad, cover a lot of business, and that's on the E&S space. And what happens is now, the commercial carriers feel a little bit more comfortable opening up some of that capacity, knowing that they can get the rate. And we're not taking anything away from the insured, but it's more realistic. We can change when market conditions change. I don't want to steal everything, Dennis, but if you want to jump in there.
Yeah, I don't have a lot to add, but I mean, the E&S marketplace has grown double digits since back to 2008. I think it was 15% last year, 30 the year before, and 20. Some of it has to do with what you all just mentioned. A lot of it has to do with the world becoming more sophisticated, insureds being more sophisticated, and a greater need for expertise. Losses, a big deal. More and more losses. So as the admitteds pull back, the E&S players come in. What else? Yeah.
I think, my thought there is that I don't think they're mutually exclusive, right? So you have, I won't name carriers, but I think folks can kind of figure out where my head's going with this comment. And that is, you have large carriers that have a big admitted arm, a big non-admitted arm, and there's a very clear distinction between the two. They have different capacity, they have different distribution, they work with us versus a retailer. They have very different appetites. So in many instances, it's the same carrier, they're just using different quote unquote, air quote, paper, if you will, in what they're doing on the non-admitted side. So it's very viable, the marketplace, and I think a very, very important tool for the clients that are listening in today to have at their disposal to work with us, again, whether it be commercial lines or personal lines. So, thanks.
And let's not lose sight of the expertise that we all bring to the table. For the most part, we're specialists. And we know our product, we know our terms and conditions. And if I'm a large insured, I want to have my insurance in the hands of somebody that knows what they're talking about. And that goes both for the carrier underwriters, for the retailers, or for the wholesalers involved.
Yeah, and Dennis, we chat frequently, and one of the things that we chat about is reputation, relationships. You and I have both been in the industry long enough where, you pick a big city, you walk down the street and you run into 4 or 5 people that you know. So if you don't mind, maybe a little bit about that.
About relationships?
Yeah.
Yeah, I mean, they're paramount. I've been dealing with underwriters for 30 years. I know how they think, I know what they want, and that goes hand in glove with qualifying accounts. And when I need something done, and it's not just me, it's all of our brokers, I know where to go, and I know what I'm looking for, as opposed to someone that doesn't. So these relationships are important, and they shouldn't be made light of. Somebody that's been in business for a long time has some really deep relationships and knows their product, and that goes a long way to helping come up with the best deal.
I can't help but think about the layer trapping comments of 5 minutes ago. If you layer trap someone in the early part of your career, they're not going to be your friend 20, 30 years from now. So really important. So thank you for that. Certainly relationships are everything. Appreciate those insights. Anela, back to you on the personal lines side. I kind of, maybe it's just me, but I feel as if we've talked so much about wind and flood and convective storms, and maybe we haven't talked a whole lot about wildfire. And wildfire more than just California, right? All of the Western states. So would you mind updating the audience today on what's going on in the personal lines wildfire space?
Sure. Yeah, wildfire season, similar to wind season, got off to a very active start. And like you mentioned, it's not just limited to California. We've seen fires in Canada in the recent months, and then even more recently, within the last few weeks, the fires in New Mexico that some are still burning and unfortunately have destroyed, more than 1,400 homes and structures. We're seeing a hotter average temperature as the summer starts to open, which is just adding fuel to the possibility of an active wildfire season. And, like you mentioned, it's not just California. It is all of the Western states. And it goes across the country too. Florida, Texas, they've also seen some of those storms. So, it used to be you thought of wildfire of just California, and that's, if you lived outside of the region, that's really all you thought, but it's really, really spread more across the country. Here at Burns & Wilcox, we partnered with Wildfire Defense Systems a couple of years ago to help mitigate wildfire risk with the homes that we insure. And we are going to be growing the number of states that service is provided in across more of the Western region. In the lower 48, and hopefully looking to be the first, if not one of the first, to bring a tool like Wildfire Defense Systems into Canada later this year as well. So overall, perils across the country, there's a lot of activity right now.
Hey, that's exciting. That's news breaking from my standpoint. So that's really great to hear. Anela, when you talk about wildfire defense systems, I recall a conversation I had a few years ago with Bill Gatewood, and Bill shared with myself and some others how our utilization with our clients and carrier partners of wildfire defense systems actually just mitigated a whole lot of loss. And I think, that's good from an insurance perspective, but think about the personal aspect of that, right? Think about the ability to go back to your home and it's intact. That's, you cannot measure that. You cannot measure the value of that. So all of our clients that have that have the wildfire defense system built in or baked in get that, and of course our carrier partners get that as well, because it certainly mitigates the magnitude of the loss, or perhaps even altogether. So thanks for that, appreciate it. Hey Peter, I'm going to go back to you now. Kind of newly formed New England region, if you will. A lot of difficult property up there, of course. I just heard this morning there's a whole lot of flooding going on up in Vermont, and so forth, as recently as today and yesterday. So talk a little bit about what's going on from a capacity standpoint in your region there. And I think you may have some exciting news to share with some of our clients that are on.
Yeah, well, I tell you what, even though Burns & Wilcox previously hasn't had a local presence, it doesn't mean that agents located in the New England area haven't accessed Burns & Wilcox, okay? And carriers have recognized that and afforded us, similar access to the capacity that they have. We're desperately trying to utilize this, whether it's coastal, whether it's, your unprotected classes. Nationwide Scottsdale has been very generous, okay, with their capacity, opening up more and more. I bet slightly higher rates, but that's okay. At the end of the day, when we get those allocations, okay, the New England office isn't quite as established to, use up all that capacity right out of the gates. So, we have that capacity, and as we're growing, we're continuing to use it, and I'm sure we will, use it to use as much as we possibly can. So.
Yeah, for sure. So, I just want to, I'll call out that we have plenty of capacity, whether it be in New England, or I'll call it the Mid-Atlantic states north. Call it Virginia on north, right? So, where I was earlier this week down in Maryland, for instance, and also Florida. where we have a whole bunch of dry powder and a whole bunch of dry powder in difficult places like Texas and Louisiana as well. So please, if you have a property need on both commercial and personal within any of those, kind of geographies that I just mentioned, please reach out to your Burns and Wilcox representative, and they would be more than happy to help you. Dennis, I'm going to switch back to you, please. And I want to talk a little bit about classes of business at this point, right? And, from a casualty perspective, what do you think are the more challenging classes of business that we're seeing, and what can we do to help the clients that are once again on the call today?
Habitational, for starters. It's been an issue with most carriers over the years, highly underrated, and carriers pulled out, they're getting back in there. We happen to have access to a handful of markets that are stepping up for a premium, but there's all kinds of limitations with terms and conditions. So you really need to make sure you're getting to the right markets. But there's classes of construction that are still issues. Liquor is another class of business that, depending on where it is and what it's associated with, can be an issue, and we get a lot of calls. We recently had security guards. Several security guards come our way because standard markets have pulled out, and there aren't a lot of experts out there. We happen to have a few, another class. And then excess in general that I talked about earlier. I mean, when it comes to large layered deals, be it property or casualty, we get called upon quite a bit.
Yeah, for sure. And, I think it dovetails real nicely with your earlier comments about terms and conditions, because, some of these more difficult classes, clients may need to make a decision. Do I want to go with carrier A or carrier B? And it's not apples and apples, it's apples and oranges, and they need to make a decision on which one they want and which one suits their needs best. So, and I think it's perhaps even more strongly underscored within these difficult classes of business. So thanks for that. I'm showing about 4 minutes left, 4 minutes left on the webinar this afternoon. I think many of the participants know that I always like to try and end with, hey, what are the pearls of wisdom from the experts on the panel, right? What are your hints and tips and things that you would suggest to the folks that are listening in today to create a better outcome? So Anela, if I might start with you in the personal line space.
Sure. Based on everything we talked about today, wildfire, hard market, hurricane season, hitting it off with bang, there are tons of ways to help mitigate risk that insureds can start taking on. And I think it's important for agents to start having those conversations, if they're not already, with their clients about these mitigation tools, because every carrier right now is looking for the best of the best to take on. And there are little things like adding a water shutoff device, making sure you have defensible space around your home, a hip roof, making sure your roof is updated in general. There are so many different things out there to help mitigate in the event of a loss, and can also help with your premium too, since we have seen those rates increase so much over the past few years. Credits are being offered. The difference between having a water damage sublimit and not having one could be as simple as installing an automatic water shutoff device, which also gives you peace of mind when you go on vacation. You'll know if you need to turn your water off or something like that. So I think that based on the entire conversation we have today, that is the biggest suggestion, tip that I could share with everyone is really look at how you can make your home or your residence, whatever the structure may be, more easily mitigated across the board.
Well, I'm smirking because yours truly had a fairly significant water damage claim at his home 15, 20 years ago. And I didn't think it was much. It was the water line that went to the ice cube maker in the refrigerator. And, I went down for my morning coffee before going into the office. And let's just say it was a big loss. But of course, if I had that water shutoff valve that you mentioned, or device, I certainly would have mitigated it at best, and had a better day. So thanks for that. So commercial lines, Dennis, Peter.
Two things. Information. I mean, information is king. The more information and more accurate information you can provide going into a placement, It's going to go a long way. And I'm talking currently valued loss runs, completed applications, correct values, correct supplementals, little history about the account. It just makes things a lot easier to get the best deal. And then the second point would be, find an expert. We talked about how important it is to have relationships and know what you're talking about. Do you really want to go to someone that dabbles in a little bit of everything, or do you want to go to the guy that does nothing but healthcare, nothing but construction, nothing but excess auto? So information and dealing with an expert, we happen to have all of them.
Thank you. Appreciate that. Peter?
Yeah, I'd say, listen, we talked about excess and surplus lines earlier and the freedom of rate and form, and what that affords is, some sense of subjectivity. We can take a common sense approach towards writing business. So tell the story behind a loss. Tell the story behind, the individual. Tell the story behind, where or what the insured is looking for. And there could be, a dozen different ways to skin a cat. So having somebody like Burns be able to navigate that world for you, okay, is invaluable.
Sure, for sure. Well, hey, thank you to our panelists, Anela, Dennis, and Peter. We appreciate your expertise and your commitment to this afternoon. More importantly, thank you to the folks that joined our webinar today. We appreciate your time. We'll get back to our normal cadence in Q4, first Thursday of the new quarter. I don't have the date in front of me right here, but whatever that first Thursday is in October, you can plan on us having the same webinar at 1:30 Eastern, and then we're going to continue in that regard. Lastly, please be on the lookout for our written report, which should be available next week via social media and other sources as well. That gets into some of the things that we talked about today and a whole lot more detail on things like environmental, transportation, what's going on in Canada, etc. So thank you, everyone. We appreciate your time and enjoy the rest of your summer. Be safe, and we will see you soon. Thank you. Bye.
Thanks, Paul.